Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're going to take a breakdown of which S&P 500 income ETF is better for your retirement portfolios, OVL or GPIX. Now we know that the Goldman Sachs GPIX is a well-known name, been established out there, but OVL has been out there just as long, if not longer, and we're going to take a serious look at the income, the growth, the stability, and of course the total returns of these funds to find out which one actually fits your portfolio the best. Let's dive into today's video. Hey, before we do, we got to do a quick commercial break, and that is for our Retirement Made Easy coffee mugs and now our license plates, which are awesome for golf carts or some vehicles. It's just something new that we've added. So many people have asked for different things. We're trying to add what we can. The reason why we do this supports the channel. Yes, those little $8.99 coffee mugs and the $6.99 license plates all help support the channel. Use the QR code on the screen or go down into the description. You'll see the links down below to get into it. You can order your coffee mug license plate for a loved one or for yourself. These things make great gifts. The reason we do this is all because it helps support the channel, so we don't need advertisers. We don't need to find anyone who's going to tell us differently, give us a biased opinion that you see so many YouTubers do. We sit here, we're going to just do something with a little logo, and you guys are loving it. Thank you so much who has bought it, and if you haven't, don't be afraid to click that link. So today, the retirement income ETF comparison, OVL versus GPIX. Which ETF S&P 500 income is better for retirement? Well, we're going to break it down because these two strategies are almost opposite from each other. OVL uses a put spread overlay, while GPIX uses a standard covered call strategy. OVL is looking for income plus upside participation, and GPIX is giving you a lower cost and a monthly income focus. So we're going to look at yield, growth, and the efficiencies across the board. Quick important disclaimer, this content is for educational and informational purposes only. This is not financial advice. If you need financial advice, talk to a financial advisor, and past performances do not guarantee future results. Investment framework beyond yield alone. Now, you guys hear me talk about this all the time, but I wanted to lay this out a little differently for you. But retirement ETF selection should weigh the full package, not just yield. So many people I talk to from our Patreon account, where you can have a 1-hour conversation with me, they always want to start off with, oh my God, this one's getting me so much yield, and this one's paying me so much yield. I'm getting distributions from this. And yield is it's a mathematical number, first off. It's not a real telltale number. And it doesn't really even tell you what your income really is. What it gives you is a mathematical number saying the price of the fund is so much and we pay so much dividend, and this is a magical percentage number of that. That's about it. So yield can change by the minute. As the price goes up, the yield's going to go down. As the price goes down, the yield will actually go up. So looking at yield only income doesn't really tell you much. You have to look at the growth side of it. You have to look at the total return side of it, which you know I talk about all the time. You got to look at your NAV performance. You got to look at the expenses. You have to look at the tax efficiency of how these things work before you even think about putting it into your retirement portfolio. So let's take a look at OVL strategy. Now this one uses a put spread and uncapped upside, which is the first thing that makes it different from any type of a covered call ETF. Now OVL holds the S&P 500 exposure through VOO, and then it adds an active managed put spread overlay to collect option premiums. So you have the core exposure, the VOO, then it's going to sell put options. Okay, put option is saying you're going to sell it for a loss. You know, if the price drops down, is where people will make their money. Versus on a call, you're saying it's going to go up, so we're going to sell it on the upside. You're actually selling it on the downside. Now, what they also do though is they buy other people's puts, something at a little bit lower value. So they're buying lower down the food chain and selling it at a higher price. So it's a unique way of that they do this. The retirement income potential, the premiums come from added income and return. So especially when the markets rise or stay flat or avoid falling below start prices, you're actually generating income across that side. Now, in a sharp S&P 500 decline, the put spread can lose money while the stock portfolio actually also falls. So it is a little risky on what they actually do. Now, GPIX strategy is a traditional covered call package. It trades the upside potential for immediate monthly income and modest downside cushioning. So it owns large cap stocks in its portfolio designed to resemble the S&P 500. It sells call options, typically 25 to 75% of the portfolio. This is a part I love that I don't think a lot of people understand. So what they do is they use a category between 25 to 75% of the portfolio is they're going to sell it as covered call options. So when the market is really rallying, they're going to take and reduce the thing down to the 25% level so they can get the natural upside growth. When the market is in volatility, they're moving to 75% so that they can gather up more income. So it gives it more of what we call a balanced approach, trying to get more income, more growth across the board, along with not using up the entire portfolio that a lot of people do. So it generates that monthly income from the premium supported, and it's also the distributions. Now the trade-off, the upside can be capped in strong rallies. Now the premiums may cushion the flat and modest downward markets. So it gives you a little trade-off between the two. Now the distribution yield, and this is where I tell everybody, you cannot just buy off of yield alone. Okay, now these are estimated based on the provided script that comes directly from OVL, because I'll explain to you what we mean by that. Distributions are definitely not guaranteed. Now, OVL changed their strategy. They changed their payout strategy. They made some big changes, and they're expecting that their distribution rate is going to get to about 10.28%. Now, currently, I always like to use actual hardcore numbers. And what does that mean? Is right now, if you take a look at OVL in the past 12 months, you're probably closer to a 6.5% distribution. But looking at the new way that they change it to the monthly payers, that they're going to be able to get to that 10.28%. Now, GPIX currently is about 8.5% annual distribution. I put that in there as targeted because that's what they're trying to do. They're trying to target right around an 8.5%. So their numbers can be anywhere between 8 to 11% category. Right now, about 8.5 is about accurate. So what happens here on a $100,000 investment? Okay, you're going to basically get $10,280 from OVL. You're going to get $8,500 from GPIX. That's about a $1,780 cash flow difference on $100,000. That's why we're saying it's about 1.75% difference between these two. So OVL actually is going to win the yield market. Okay, but these numbers don't mean anything to me right now. The yields tell me, oh, how much income I could potentially make, but I don't know, are we losing it in growth? Are we gaining it somewhere else? What is actually going on with the fund? We don't know. So round 4, we get the share price growth performance. Now you can easily take a look at this. This is a 1-year price appreciation. Now this is going to basically come to you. 1-year price up about 17.2% OVL. On the GPIX, it's up about 11.5%. So what we're seeing with this now is OVL is winning again because of the growth of the fund. Now everybody needs growth, even in a portfolio, in a retirement portfolio, because you have inflation, you have cost of living going up. You got to make sure your fund is growing, not declining, even in retirement. Now, round 5 is probably the most important one that we're going to look at. And this is going to be your total return. So this is going to be your income and your growth all tied in together and taking a serious look at what a performance is actually looking like. So as I said earlier, you know that you have OVL, okay, sitting in that 10 and a half, we'll call it 10.5% yield. You have GPIX sitting at about 8.5%. When we take a look at the total returns, you take that yield from the total return. And what does that give you? So if we're looking at 10.5, we're looking at really about a 16% growth. See how total returns can tell you more about a fund without even looking at anything else? If you know your yield, if you know the yield right up fat and immediately go to total return, you can see if the total return is larger than your yield, then you have some growth involved into it. If it's less than your yield, then you know it's just your money going back to you. So OVL is winning this at 26.4 versus GPIX at 21.5. It's about a 4.9% difference between the two funds. So realistically, these funds are dealing with about a 5% difference between each other. Now, OVL has been trading since September 9th of 2019, so it has a little bit of history, and you can see the value has been up there across the board. Now, GPIX started operating in October of 2023. It's a shorter life record. I'll say it's not been tested through full market cycles, through the bears and the bulls and long periods in both. But I'm not going to say GPIX is a bad fund. Don't get me wrong here. I'm not saying it's a bad fund if you own it. Personally, I have to say it. I own it. So it's not a bad fund. It's just OVL has done better performance in the S&P 500 category. Now, round 6, the expense ratios. This is another one I hear a lot of people talk about, and I always got to explain this to people. Expense ratios, as everything that you show and most of the stuff you look at, all have expense ratios calculated into it. So, OVL, if you're getting an 11% yield, you're already adding in the expense ratio part of it. It's also part of the growth side of it. So what we look at, why is this number very important? How long are you going to hold these funds? So if you hold OVL and you hold GPIX for the same exact period, you bought them both the same day and you carried them for 10 years, there's about a 0.5% gap difference between these two in the expense ratios. Okay, what does that mean? Well, it's $500 more per year on $100,000 invested. So if you hold these for long periods of time, it's going to be more cost effective to you and you're going to gain more money to it by having a lower expense ratio with GPIX. So I'm going to put the winner in GPIX. Goldman Sachs does a great job of keeping their expenses low in their particular ETF funds. Okay. Now, this fund, I'm going to tell you, I put the note here, is through at least April 30th, 2027. GPIX has already said, Goldman Sachs has already made an announcement that they're probably going to be increasing their expense ratios. I think it's going to go to 0.35, to be honest with you. So that's another factor to this. Still going to be less than the OVL, but right in line. So if you sat there and said, hey, if I'm holding these for a long period of time, this is a concerning point as well. You have to make sure OVL is going to make up at least that extra 0.5% across the board, which right now we show everything that it has. Now, tax treatments. This is where it's going to get really, I'm going to call it really crazy and what we start talking about. The tax treatments. Both funds recently reported high ROC distributions, but the option structures may differ at tax reporting time. And so many people don't understand this and don't get into this, but I just did a big video on ROC, how it works, and explained more in detail how it all works and what the positives are and the negatives are across the board. So here's what we got. OVL just reported about 100% return of capital, ROC. That's their most distribution estimate. Now, OVL also has an option because they do their index option tradings that they're going to have 1256 tax treatments at the funding level, which is the 60-40 long-term, 40% short-term capital gain treatment. Both of these funds use ROC as their first line of defense. OVL does not use the 1256 as much as a big key factor to it. They use more ROC. Same thing with GPIX. They use a ton of ROC across the board. But here's the point that I get to with this, why I say it's confusing. Both of them are about equal to each other. That 92% or that 100%, quite frankly, means absolutely nothing to me until you get your 1099 dividend form. So ROC is not free money. It can defer your taxes by reducing your cost basis, but final classification depends on your year-end form, that 1099 dividend report. I've seen reports that have gone through where people have said, oh, I'm getting 100% ROC all the way through, and they finally get their 1099 DIV, and it comes back and was 18.9%. I talked to a friend of mine who's a CPA, and he says, oh my God, I see it all the time, Doug. I freak people out at the end of the year because they've been planning on it. They say they got ROC is going to work out great, and all of a sudden they get the report and it's wrong. So these are things, they look alike, they're acting alike, they're doing the same thing. There's a OVL has maybe a little bit change to it with the 1256, but overall these are identical pieces using ROC as number one line of defense. But just remember, you need that 1099 to do it. So I'm going to put a tie on both of these, and I'll put them ahead of myself just a hair with the screen. But the winner of the tax inside retirement accounts is really a tie. If you're putting this in a traditional IRA, Roth, or a 401k, they're operating identical. It's not going to be a big effect difference for you. If you're putting it in brokerage accounts, the difference is going to be that ROC, that 1099 form at the end of the year, that I could actually tell you OVL or GPIX is actually moved better one way or the other. But across the board, I'm going to tell you straight out, I think you're just going to have a tie across the board on these two, if anything. Now, assessing the retirement risk. This is where it really gets critical here. Income strategies still carry an equity market risk. OVL with their put spreads can lose on stocks and options during sharp declines, while GPIX may lag in the recovery. If we've had a drop off, it'll lag in recovery because it caps that upside side of it. So these are the things, the short put exposure, the losses may exceed the premium collected, and the sequence of return risks for retirees, while GPIX has the capped upside. The call premiums offer a limited cushion and still exposure to bear market losses. Neither fund should replace cash bonds, short-term treasuries, or defensive assets. So I'm going to tell you right out front that these two funds really should be in your growth bucket. In my 3-bucket portfolio, really should be in the growth side of things, not in a foundation package. So let's give you the head-to-head scorecard where we sit. High distributions, OVL wins it with that 10.28% yield. Strong one-year price growth, well, OVL continues on with that 17.2. Strong one-year total return, OVL wins with that. Basically, we showed you that 5% difference to that 26.4% total return. Expense ratio, GPIX, Goldman Sachs is going to win this one against everybody all day long. So longer operating history, we got to give that to OVL. And the tax treatment, I'm giving it a tie. They both do great jobs with the ROC. I think they use it properly, not not using it against it, trying to achieve a unofficial yield. The greater upside participation, OVL is kind of giving you that little side of it, and the traditional option strategy is GPIX. So overall, we have 5 wins for OVL, 2 wins for GPIX, and 1 category we're actually going to tie in. So my final verdict is this. OVL is actually the clear winner between these two funds. I'd love to hear your comments down below. I'd love to hear what you guys have to say on that statement. If you think OVL is not the winner and GPIX is the winner, let me know. I'd love to hear from you and tell me why. As I told you, I own GPIX. I like that fund, so I'm not against it. I'm not saying it's a bad fund. But OVL just gives us a win because of those higher lead on income. It's given me the growth that we're looking for. It's winning in the total returns. So it's winning in all the factors that we talk about and the longer history that's out there. Now, GPIX still remains very, very competitive. That lower cost for holding long period of time It's producing some decent distributions and nice total returns across the board with that traditional cover call approach and using that 25-75 spread. I love that system across the board. But OVL definitely over between these two actually is a clear winner when it comes to the categories we talk about. Now, implementation of all this is where it really gets fun, at least for me, is, you know, this is not just a concentrated win and say, hey, buy OVL, I'm done. Put all my money in OVL, I walk away and I'm done. You got to pair your defenses and your assets, okay? And you got to protect against sequence risks. What I like doing is taking OVL as my core, okay? Put that in my income bucket. It is my core income, and I'm getting some growth from it. Now, what I do is I use GPIX as a satellite, okay? So when OVL gets to its maximum potential in my particular fund, GPIX is now starting to fill the next part of it, and it helps add to my income side of it. So core versus satellite, okay? So these are how I use these things accordingly and use it properly. And I think both funds can actually do what we're asking to do. Let me know your thoughts about this. Let me know what you guys think about it. Do you think OVL is actually a core piece? Leave your comments down below and definitely hit that like button. Now, I got to say it one more time, guys. Our Retirement Made Easy merchandise, the coffee mugs, have been selling phenomenal. Thank you so much for the support. It really does help the channel. Our license plates are brand new. Jump out there. We've had a few people jump already, ordered a couple of these. Let us know. You guys are liking what we're doing. Everything helps support the channel. Use that QR code. Leave the links down below. Thank you so much. Definitely hit that subscribe button, hit that like button, and we'll catch you on the next time.